Hi folks, welcome to this final video on the question which addresses some theory issues associated with IFRS and ASPE. The first question is, what should Chloe's approach be for determining its allowance for doubtful accounts balance when considering lifetime expected credit losses, and what's meant by the concept? Well, as we discussed, lifetime credit losses are really what you would anticipate being the impairment amount on the account receivable over the time it's been outstanding. Now, again, we're talking about current accounts or current assets when we talk about accounts receivable here. So the lifetime of the receivable is really not that long. But the idea is the company under IFRS needs to examine all possible defaults that could happen over the life of the receivable. I don't care if it's a 30, 60, or 90-day receivable. The point is the company, your customer's company, could have changed their financial position from the time you granted them credit terms to the time you're now selling to them on credit. Their financial situation might have changed. What if there's indications that you might not be able to collect from them because maybe there's a possibility of them going bankrupt? Maybe technology's taken over, or maybe there's been a lot of new competitors in the industry and they're struggling to continue being competitive in that industry. So there might be other things from the date you granted them credit to now that might have impacted their liquidity or even solvency position. So we need to make sure that when we're applying IFRS that we're fully disclosing the value of those receivables based on any of those situations that might now mean maybe there's a bigger impairment on the horizon for the receivables. So we have to evaluate and look at a range of possible outcomes that might have happened to affect that receivable. So what past events have happened? Has your customer lost a major customer? Is your customer going bankrupt? Has current economic conditions changed their financial position? Right? So we look here to economic conditions. And is there a probability of these things even occurring for that particular customer? There's no such thing anymore as being too big to fail. We've seen a lot of big companies fail. So we need to be mindful that perhaps somebody whose credit worthiness might have been higher when we initially granted them credit terms might have been affected. So we need to evaluate all those things. The second part of the question says, would a percentage of credit sales approach be appropriate for determining the allowance balance under IFRS 9 or under your IFRS standards? We would say no. And the reason is that because when you use a percentage of credit sales approach, we're really relying on historical data to determine what the estimate for uncollectability will be, and we're only looking at a small segment of sales for a period. So it might not reflect all of the expected credit losses that we might be anticipating for all of the customers that we sell to on credit. So this is great. This percentage of credit sales approach is great if you're just looking to adjust your allowance based on estimates of what you think is going to happen by the end of the year based on what's happening over a period of time. So say, for example, you make your adjusting entries monthly. You might look at credit sales for the month and adjust based on a percentage of net credit sales just based on what happened for that month. But we want to look under IFRS, they want to look at the overall quality of the receivable. So they want to really test the balance that's in the current assets section of the balance sheet to determine, is that in fact a good number to use, or what is the right value for that receivable at net realizable value. So the allowance method should be applied at the reporting date to further examine, the makeup of the receivables at that time. So again, going back to, what is the quality of the receivable that we're showing at its net realizable value. Now, the third part of the question says, how would Chloe's approach to accounting for sales returns and allowances differ under IFRS? Well, again, you'll remember we talked about this. Under IFRS, if you look just here on the left, when we have a sales return, we would debit sales revenue directly and record a refund liability, which is a current liability on the company's balance sheet. So in this case, what we're doing is we're estimating in both cases how much we believe are likely of being returned. So we're coming up with estimates. So under IFRS, they would say if there was a likelihood that you're going to have to refund a customer, under IFRS, they consider that a liability. Under ASPE, they have different rules. They would debit the sales return and allowance account, which is what you're more familiar with, but instead of crediting a liability, they would credit what we call an allowance for sales returns and allowances. And you'll remember that when we talked about this account, this allowance account is a contra asset account. It's a contra asset to the accounts receivable account, right? So it's a contra to that. So it has a normal credit balance, and its credit balance would be added to your regular allowance for doubtful accounts balance, and both of those allowance balances deducted from your receivable at gross to come up with your accounts receivable at its net realizable value. So while IFRS sets up a current liability, these guys set up a contra account, a contra to the accounts receivable account under ASPE. So hopefully this successfully concludes for you, for your understanding the theoretical part of this question.